Welcome to the weekly market recap with SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka is moving into a critical phase of its national recovery effort as the government begins formal discussions with the World Bank to evaluate the full impact of recent floods and landslides. According to officials, the World Bank has already been commissioned to conduct a global rapid post-disaster damage estimation known as a grade assessment. The government expects the findings within the next 2 weeks, which will help determine the exact scale of destruction and the financial requirements for rebuilding. President Kumara Dissanayake, speaking at a meeting with private sector investors at the Presidential Secretariat, explained that the devastation across many districts is significantly greater than what appears on the surface. He noted that the Treasury cannot shoulder the entire cost of recovery on its own. The President had outlined plans to establish a dedicated reconstruction fund, which has since been set up with contributions expected from public institutions, private companies, Sri Lankan expatriates, foreign governments, international agencies and business associations. A joint management committee made up of both public and private sector representatives and appointed with cabinet approval has been tasked with overseeing the fund's operations. He indicated that the scale of damage is widespread. Homes, farmlands, plantations, highways, bridges, government buildings, schools and even electricity infrastructure have been destroyed. He added that landslides have severely impacted road networks, creating an urgent need for major rehabilitation work. Officials say the upcoming grade assessment will serve as a foundation for coordinated resource mobilization and long-term reconstruction planning. Sri Lanka's foreign currency debt repayment obligations are projected to increase sharply from 2028, reaching between $3.25 billion and $3.5 billion a year if the current debt levels remain unchanged. According to the central bank, repayments will remain relatively lower through 2027, with annual payments capped at around $2.75 billion until full sovereign bond obligations resume in 2028. Data from the Finance Ministry shows that Sri Lanka has already settled $1.67 billion in foreign debt during 2024. For 2025, total repayments amount to $2.43 billion and $1.95 billion of that had been paid by the end of September. The ministry projects that only $487 million remains to be settled in the final quarter of the year. The debt service requirement is expected to rise to $3.26 billion in 2028, an increase of just $824 million compared with 2025. Officials also highlighted the recovery potential of the tourism sector. Sri Lanka is expected to earn $8 billion from tourism by 2030, a forecast also supported by the Sri Lanka Tourism Hotel Association, though the industry emphasizes that additional effort is required to achieve the target. The country previously lost nearly $10 billion in tourism revenue during 2020 and 2021 due to pandemic restrictions. In addressing public concerns, President and Finance Minister Kumara Dissanayake said that the reports claiming the country may be unable to service its debts in 2028 are unfounded. Meanwhile, the central bank announced that the government expects to receive around $750 million in December 2025 from multilateral partners. This includes $347 million from the International Monetary Fund. Sri Lanka is set to receive the 6th tranche of funding under the International Monetary Fund's Extended Fund Facility. According to an IMF representative, the country is expected to gain swift access to around $350 million within the next 2 weeks. This announcement was made during a high-level donor forum convened by the Ministry of Finance. The meeting brought together diplomatic missions, development partners and international lending agencies to review the impact of Cyclone Ditwa and coordinate support for national relief and long-term recovery. The forum was co-chaired by the Governor of Central Bank and the Secretary to the Treasury. Senior officials from several key ministries, the President's Office, the Disaster Management Center and the Treasury participated in the discussions. According to the President's Media Division, development partners reaffirmed their strong commitment to assist Sri Lanka during this critical period. The Treasury Secretary outlined the extensive damage across multiple sectors and explained the government's plan to shift from immediate emergency response to a broader long-term recovery framework. He emphasized the need for humanitarian support, concessional financing, and medium-term development assistance. The central bank governor highlighted the importance of external financing, noting that domestic borrowing options remain limited due to contracting economic activity. Government representatives also encouraged development partners to promote international engagement and support tourism, which is vital for economic recovery. Development agencies also agreed to repurpose existing loan facilities for medium-term reconstruction of roads, bridges, irrigation networks, and other critical infrastructure. They further discussed new loan and grant packages to support long-term development needs. Sri Lanka's external sector remained resilient in the first 10 months of 2025, although the current account slipped into deficit for the second consecutive month in October. According to Central Bank's latest external sector performance report, the deficit for October reached $199.5 million, widening $183 million in September. Despite these two monthly shortfalls, the year-to-date current account still recorded a surplus of $1.65 billion by end of October. However, this is lower than $1.9 billion surplus recorded by end of September. The central bank attributed the year-to-date surplus to moderate growth in merchandise and service exports, stronger tourism earnings, and higher worker remittances. Trade trends, however, continued to shift. The trade deficit nearly doubled to $1 billion in October as import growth outpaced exports. Imports rose 26.7% year-on-year to $2.16 billion, while exports fell slightly by 0.7% to $1.15 billion. Over the first 10 months, imports grew 13.8% to $17.55 billion, while exports increased 6.4% to $11.4 billion. Vehicle imports remained a key contributor, amounting to $261 million in October and rising to $1.46 billion for the year so far. The terms of trade deteriorated during the months as import prices climbed faster than export prices. Sri Lanka recorded $3.1 billion in net service inflows from January to October, an increase of 2.6% from a year earlier. In October alone, service inflows rose 14.9% year-on-year to $245 million. Tourism continued its steady recovery. Tourism arrivals increased on both monthly and annual basis, with earnings reaching $186 million in October. Cumulative tourism revenue rose nearly 5% to $2.66 billion. Worker remittances delivered one of the strongest performances. October recorded $712 million, the highest monthly inflow since late 2020. Year-to-date remittances rose 20.1% to $6.52 billion. Foreign investment in government securities also strengthened, with net inflows rising 81.5% year-on-year to $70 million in October. However, the Colombo Stock Exchange saw net outflows of $18.7 million compared with a modest inflow recorded a year earlier. Gross official reserves stood at $6.2 billion at end of October, including the currency swap facility with the People's Bank of China. Meanwhile, the Sri Lanka rupee depreciated 5% against the US dollar on a year-to-date basis by end of November. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.51%, down by 1 basis point. The 182-day T-bill rate stands at 7.91% and the 1-year T-bill rate stands at 8.03% with no change in basis points compared to the previous week. Thank you for watching. We'll be back next week.